got a global voice in Johnathan Schiessl, Deputy CIO, Westminster Asset Management, at a crucial time, because we'd love to understand how is it that Johnathan himself and maybe some of the other people, clients, etc., are thinking about this situation. Johnathan, great having you as always. Good morning to you. Are you of the opinion that this will be contained and therefore a flare up in oil prices, etc., may not be the outcome that is most opined upon, or do you reckon there is a possibility? Because I hear now both views. If there's a prolonged battle, then do we see oil flaring up higher as well? How are you looking at this?
Yeah, I think the obvious thing is if you look at oil prices versus, say, gold, then clearly gold is pricing in a lot worse a scenario than what we're currently seeing in oil prices. So we think energy complex is quite attractive here from a hedging or a risk perspective. But yeah, I mean, who knows where this is going to go? It could go either way. Clearly, markets are suggesting at the moment not to get too concerned. Usually, historically, most geopolitical events are brushed aside by the market after a short amount of volatility. This one, we shall wait and see. It could, you can, as you rightly say, you can build both sides to the story, whether this can escalate or ease off. I mean, obviously, oil prices moving the way they have are not great for global growth, and ultimately that could be the fix. High prices will fix high prices, if you know what I mean.
Okay, no, but Johnathan, the argument could be that in gold's case, there is real demand. It's been there for some time now, and hence there has been that surge. Whereas in oil's case, the real demand is absent relative to gold, and therefore some bit of that dichotomy in the ratios might be well warranted.
Yeah, no, I take that point, and obviously gold is moving. It's not just geopolitics which is shifting the gold price. There's other factors at play, but I think the gold complex does look, and precious metals generally do look as though they're pricing in a more difficult geopolitical environment than oil. And I mean, oil. It was interesting to see the last month or so where before this event, before the issues in the Middle East started happening, that oil was moving higher despite increased production. That OPEC announcing an uptick in production, so quite elevated production still, and oil was moving higher. Now, was that a reflection of perhaps emerging market economies and Europe beginning to come out of its sort of sleepy phase and see a bit more growth? So I think obviously there are other factors at play in the oil complex anyway. But it was interesting that oil was moving higher despite increased production, over the last few weeks.
Okay, so Johnathan, Harsh also joining in, wanting your take with regard to how global markets are cushioning this risk, because we've seen maybe a 15% rally in oil prices. This could well pose downside risks to inflation. Global markets completely brushing that off.
Absolutely. The markets are totally ignoring, just assuming that the oil price won't move much higher. But as you rightly say, there has been nerves over inflation for some time. Yes, we've had a couple of, the inflation print last week out the US was slightly better than expected. So there's no sign of tariff inflation coming through just yet in the US. But clearly, while all that has been going on, a weak oil price and a weak energy complex has helped inflation everywhere. And that if prices remain elevated for some time, then there is no doubt that the likes of the Fed and other central banks will be a bit more cautious cutting rates. So I think that scenario is very negative for equity markets. You're seeing a rising inflation and falling growth scenario, then equity markets will, I think, take some considerable pain.
Does that, Johnathan, also mean that likely this, it's unlikely to translate? Is that how one should look at it? Because basis past precedents, on most occasions when a conflict in these geographies has arisen, we haven't seen a very permanent dent to oil prices, and the reversal has been equally quick. And hence, just trying to get your perspective. Is that what equity markets are already reading, and therefore they're looking through the event?
Absolutely, totally agree with you.
And is that appropriate? Sorry.
Well, I mean, we all know that the situation in the Middle East is very fast moving. And obviously, if the Straits of Hormuz were closed off, I think oil prices, well, most people say, the experts, that oil prices would move substantially higher. But obviously, clearly, markets are saying we're not going to get that, get to that sort of impact, and therefore they're just seeing through it, as you say. As we said earlier, most geopolitical events are very quickly priced in and then very quickly priced out of markets, and that's been the right thing to do. But there is clearly risk this could escalate, and so I think most investors, perhaps as a hedge against that, cheap energy stocks which remain under-owned and remained very, very cheap valued isn't a bad way of hedging some of the risk that things could get worse.
Okay. Johnathan, one final question from mine at least. What about a call specifically on India? I mean, it's not that foreigners are highly big owners, right? If anything, the weightage currently is on the short side, if you will, both in the trading positions as well as possibly in the long only portfolios. It's not heavily owned per se. Growth seems okay. Except for this oil piece, everything else seems to be okay. Is it a good shoe in? I know in the past you've told me that anybody who's missed India thinking of expensive valuations has only licked their wounds, right? Do you reckon that story still holds?
Yeah, I mean, obviously last month foreigners were net buyers, but as you rightly say, year to date, foreigners have been pretty heavy sellers of India. Market has bounced substantially. I think, a couple of months back, after the sell-off that we'd seen, the extended sell-off, I think India was looking very attractive. Obviously, we've pushed very substantially higher, just short of all-time highs. So markets have moved up again, and valuations consequently are looking a bit peaky again. So I think probably in the short term, with worries over energy and India's issue about import dependency in that area, perhaps EM and India could come off a little bit. But I think ultimately the other interesting thing about this whole scenario is the dollar. The dollar clearly is not doing what it usually does in these safe haven type events. The dollar has continued to weaken off. It's not strengthened at all. And ultimately a weak dollar is good for India and good for other emerging markets. So I think it is a balanced view. We're still quite optimistic on emerging markets and still do like India.
Okay. Thank you, Johnathan, for coming in, speaking with us, giving us that perspective. We'll let you go on that note. That's, of course, the global view, global perspective also coming in. We've spoken enough about oil and macro.